So over the years, I've managed to build a stock portfolio that's now well into the six figures, and it's really true what people say. Your first 100K is going to be the hardest thing ever, but from that point onwards, things really accelerate. So to accelerate this even further, I've decided to be very ambitious / aggressive this year, and the goal is to invest at least $100,000 in ETFs this year. Now, after I pay all my expenses and pay off the mortgage, which we'll get into, I don't have nearly enough left over, so how am I going to do this? It's going to be mostly done through debt. My goal for 2025 is to really pour some gasoline on my portfolio and supercharge the portfolio for compound interest and the compounding growth that is going to hopefully follow in the years to come. When I think about it, it's something that I should have done a long time ago, because up until now, the returns would have compounded really well. But there was always a part of me that was always scared of using debt to invest, and that's something which has always held me back. But over the years, especially the last couple of years, I have been trying to basically unlearn this thought process. So we're now in mid-February, and so far I've invested 10K in January, and I'll be planning to invest another 10K in February as well very soon. Luckily, the portfolio has grown quite a bit, so the 10K that I invested in January was done 100% through debt. I didn't have to actually put any of my own money through to borrow against the purchase. It was financed fully through the equity in the portfolio in my shares. The focus right now for me with my cash is to save. I've got some big expenses coming up, like donation expenses very soon. I've got a holiday booked in April and also a potential holiday in September as well. And also I need to beef up my emergency fund. So my cash is going to be used towards those activities, while my investing activities will be done through debt. Time in the market is the most important thing, which is the reason for going so hard. Let me show you guys. If you were to invest $2,000 a month for the next 3 years at 7%, at the end of 3 years, this will leave you with $77,000. However, if you were to use debt and beefed up your investments to, let's say, $10,000 per month, at the end of the 3 years, you would end up with $386,000. Now, if we didn't do anything with that money, we didn't make any investments for the next 27 years, after the end of that 30-year investment period, with the first scenario, you would end up with $478,000. But in the second scenario, where we used debt and we went hard for just a few years, we would end up with $2.4 million. So you can really see the impact that debt has, even if you just used it for just a few years, went hard, and then at the end of it, you reap the rewards. Now, yes, of course, if you're using debt, there is a trade-off there. You need to service the debt, you need to service the interest. But if you do the calculations, if you compare the long-term average returns of the stock market compared to the average interest rate that you would find for that time period, you'll find that you do come out ahead. And if you think about the rates that we're seeing now, where the rates are very high, this is not going to be around forever. There are rate predictions that are happening right now to show that rates will be coming down very, very soon. So it's not appropriate to use the current rate, it's appropriate to use the long-term rate, which would be 1 or 2% below what we're currently facing now. Now, of course, the good thing with ETFs is the fact that you can sell them at any time. You can sell today and get your money back in 2 days. It is highly liquid. And I also find that it's very interesting that people will borrow hundreds of thousands of dollars to borrow against property. They can borrow at 90%, 95%, and nobody really thinks too much of it. They don't really think of it as something which is risky. But when it comes to shares and ETFs, suddenly it becomes a lot more riskier. And I think this is where the knowledge gap is when it comes to investing in shares and property. Since property is so ingrained in our culture and it's a tangible asset, people automatically think that it's a safer investment vehicle to put your money in. But at the end of the day, property and shares both give unique advantages. Now, I have to say, using debt to invest can give you magnified returns, as we just saw, but it can also go the other way and give you magnified losses. If you're watching this video and you're a beginner, do not even think about using debt. Whatever I'm planning to do is based off my worldview, it's based off my learnings, and it's based off my experience of being in the markets for 7 years. I've tried a whole bunch of stuff, I've lost a whole bunch of money, and I've made it back, and I've gone through at least 2 to 3 proper market crashes so far, so I know what I'm in for. If you're just starting out, you should not automatically assume that you have built up the emotional muscle to deal with the market crash, the market downturns, because it can get pretty rough. Trust me, when the market isn't doing too well and your friends and family are all talking about a crash, your co-workers, especially if you work in finance, are all saying the same thing. The news articles are out there adding fuel to the fire, really building up the anxiety in the society. And to top it all off, you have got leverage against your portfolio. So not only have you lost your own money, but you've also lost the bank's money. It's going to be enough to make you sell at the worst possible time and lose a lot of money. Do not underestimate this. A lot of investors out there, especially myself, overestimated themselves in the beginning. A lot of them lost a lot of money. Some of them do not learn their lesson to this date, and they continue to lose money every single market crash, and more money if they decided to borrow to buy investments. So the lesson here is to always invest according to your individual risk tolerance, because it's going to be different for everyone. It's very easy to look back at the S&P 500 market chart or the ASX 200 market chart, look at the little crashes and look at the little downturns and think to yourself, if that was to happen to me, it's going to be fine. I'm just not going to sell. I'm going to keep on buying. And it's very easy to look at this and say this in hindsight, but when you're actually going through it, it is a completely different story. Trust me, I've been through this. I'm not saying this as a joke. So basically to say, everything that I say in this video is not financial advice. And if you need financial advice, please speak to a financial advisor. So that's it for stocks. Now jumping into property. So my property settled in Perth a couple months ago, and I've got a few plans for this as well. So goal number one is better cash flow. So currently it's negatively geared, meaning the income that the property generates through rent is not enough to cover the expenses that the property accrues. So things like insurance expenses, interest expenses, rates, and things like that. So this means that each month I have to personally contribute towards the property using my own cash. So this year I want to try and get it to be as close to neutrally geared as possible. So currently the property is rented out for $28,000 per year. This is a gross rental figure, and the interest cost per year, which is the biggest item of expenses, turns out to be around $34,600 per year. So on a yearly basis, I'm down $6,600 or $550 per month. Now, of course, this is a very simple calculation. It doesn't take into account any management fees that are charged every month. It doesn't take into account rates, insurance, or repairs. So the actual figure, of course, is going to be more than this. So getting the property as close to break even as possible needs, of course, two things: income to go up, expenses to go down. The income I can control to some extent, the expenses not so much, but how I'm envisioning this whole plan coming to light is, first of all, with the income, I'm planning for the rent to be increased in August this year. Due to WA laws, rent can only be increased once per year, so August is when the rent can go into effect. Now, currently the market rent for the property looks like to be around $600 to $650 per week, which is around $31,200 to $33,800. But these figures are at this point in time, and it's very likely that the figures are going to increase in 6 months' time. So let's assume that the rent goes up to $620 to $670 per week. I would be more than happy to take the lower end of that rent range, so $620 per week, which turns out to be on an annual basis $32,200 per year. So that's about all that can really be done on the income side of things in the short term, at least. On the expenses side, you would have heard a lot about rate cuts this year, especially in the next 6 months. It is very, very likely that we're going to see at least 1 to 2 rate cuts. In fact, 96% of the market right now has an expectation of a rate cut in February, which increases to a 0.74% rate cut by August 2025. And if I go off of a prediction of 0.75% rate cut and apply that reduction to my investment loan, the loan interest rate would be 5.64%, which means that the annual interest cost would be $30,456 compared to the gross income of $32,240. So it does end up in the positive until you realize that there are, of course, costs against this as well, like management fees, council rates, etc., etc. So it is not going to be fully positive, but at this point, I will take what I can get. All I know is that comparing the property situation from this point to in 6 months from now, the 6 months from now situation is going to be a lot better in terms of cash flow, and I'll take that. Goal number 2 is to access equity, which is extremely exciting. So it's very likely that the rate cuts are going to bring more borrowers into the market with improved borrowing capacities. So the property value should increase some more. Right now, I'm seeing comparable sales for my property go for around $700,000. Same characteristics. So conservatively, I'm hoping that the property would be worth $700K in 6 months' time as well. So given that I bought my property for $625, the value is $700K, and I can borrow 90% of that, I should be able to release around $70,000 worth of equity from the property for other investments. Now, at this point, I'm not really sure what I want that money to be used for, whether it be for ETFs, whether it be to buy another property, or whether it be just sitting in my offset account, ready to take advantage for the next opportunity that comes up. All I know is that I want that money in my bank account. Someone who is vastly more successful than me told me that even if you don't intend to use it, equity is much better sitting in your offset account than locked inside your property. And after hearing that, I absolutely agree. I'd love to hear your investing plans for 2025 and let me know in the comments below. And if you want to hear more about my property journey, especially the numbers, check out this video right here, which dives into all of that. Subscribe if you enjoyed this video. Bye now.